Kyle and Daniel. Kyle and Daniel are American Savings Bank representatives. Kyle is the Senior Vice President and Director of Corporate Banking, and Daniel is the Assistant Vice President.
Thank you, Addie. Yeah.
Thanks, Addie.
Yeah, so just a little bit more background about myself. I started in finance acquisitions shop in San Diego. That was back in 2007. So that was right before the great financial recession for those that maybe experienced it or at least read about it. So that was a very tough period. Debt capital dried up. Lehman Brothers, different institutions went down, banks closed. And then after that, I had a change of values. I felt like I wanted to go back to island culture, being from Guam. And I didn't want to go to New York or San Francisco. So Hawaii was that middle ground for me to still be in finance and, have some urban life and enough people where I felt like, I could connect within the community and whatnot. So, and Guam was just too hot for me growing up there. So I ended up going to Bank of Hawaii for a few years, and I spent just a couple of years there. And then I went to American Savings Bank, and I've been there for about 12. Daniel's background is much more interesting than mine, so I'll let him introduce himself. And
I was being too humble. So hi, everybody. Good morning. My name's Daniel Kaanana. So I work under Kyle at the corporate banking department over at American Savings. Most recently joined corporate about a year ago. And previous to that, I was at ASB as a credit analyst. So kind of more behind the scenes, kind of analytical work. A lot of the stuff we'll dive into today. Previously to that, I actually started in the aviation industry. I worked first as a flight attendant over at Hawaiian, moved over to the pilot side, got my licenses over in Arizona, came back home, started instructing, and ended up becoming a commercial pilot. So a little different, kind of walk of life, but nevertheless, I think it's been beneficial, in my journey through banking. And Kyle's been very supportive in helping to mentor me and tutor me too with a lot of what we're discussing today. So just want to welcome you guys. Thanks for joining us. I know it's really early in the morning. We'll try our best to keep it fun, light, entertaining, and provide some value to you guys that you can take home with you after the presentation today.
Yep. So, all right. So this is a cash flow class. So we do intend to go over cash flow. So we're going to cover some basics. Then we're going to talk about EBITDA, earnings before interest, taxes, depreciation, and amortization. Maybe just a show of hands. Is this your first time to hear that term EBITDA? Yeah, I see a nod too. Okay. Yeah, it's a very common metric used in the real world. So that's why we're going over it today. And it's definitely something we use at the bank quite frequently. And then we're going to do proxy free cash flow kind of conceptually and give you some technical ways to get that number without necessarily going through the details of isolating exactly what your free cash flow number is, which you should do, but we're going to try to give you a high level view. Then we're going to talk about sustainable growth rate, which is the rate of growth that you maximally can achieve without having to borrow any additional capital or inject any additional equity. That's something that you should know, and that's going to really dovetail into the cash conversion cycle. How long does it take to convert a sale of whatever it is that you're servicing or manufacturing into cash? And then we're going to do a case study, probably take a 5-minute break before that, and get into an Excel model and kind of show you some numbers and how that flows into growth and cost and your cash conversion cycle. All right. We do want this to be interactive, so we'll probably pause and see if there's any questions along the way, but don't wait for that. Just raise your hand and we'll get into it. Yes. So the slides and the Excel calculator afterwards will be circulated.
All right, so real quick, just kind of high level, right? So the whole purpose of us kind of sharing what we have today is, first and foremost, we wanted to quote this statistic from an article, which we'll show later. But the article states that 82% of small businesses fail because of poor cash flow. So one thing that's really misconstrued is profit. So oftentimes we see these high growth companies making what appears on paper to be tons of money, right? High net profit, high revenues, insane sales growth, right? But what you can see, right, is over time, as we go through our presentation, there's a clear difference between what you see on paper as far as profitability as opposed to what we actually need to pay attention to, which is true cash flow. One thing I wanted to share with you is just a quick story, right? So from a banker's perspective, promise it won't be boring. But when Kyle and I were working on this presentation, something that came to mind was my brother. So my brother's wife recently started during COVID, a dog toy business. Same thing that we'll see throughout our presentation, just skyrocketed in sales, right? They're crushing it, doing well. But something that I often hear from him is, brother, we're doing so well, but for some reason, there's never enough cash, right? And everything they're trying to do to support inventory, to support that growth, for some reason, it's like they're taking 2 steps forward, 1 step back. So we'll start to peel off the layers of the onion today. We'll show a little bit more of the perspective as to why that's occurring. Next slide.
And maybe before we get into, there's the footnote on that study, US Bank on 82%. Does anyone have any like burning questions that you want us to potentially go over in today's session? All right, cool. Okay, so cash flow basics, we just got to start, foundationally. Sorry, we just see. Was there a question? No. Morning.
Morning.
Thank you. Thank you for coming. All right, so movement of cash. It's pretty simple. Cash coming in and cash coming out. And what happens is over time, as your business matures, you end up having accrual accounting and GAAP accounting, right? Versus maybe a cash statement. And that's really why we focus on cash conversion cycle. But on a cash flow statement, it's one of 3 key financial statements. So you're going to have your income statement, you're going to have your balance sheet, and those 2 manufacture the cash flow statement based on movements of your assets and your liabilities and what your revenues do. So it complements the balance sheet and the income statement. Pretty self-explanatory. It's summarizing the cash movements in 3 key areas. So first one, this is accounting. One, you have your operating cash flow statement, right? That's your sale of goods and services, payment on wages or rent. Those might be typical expenses or supplier payments. Then your investing cash flow section. So those would be like asset purchases, right? Equipment or potentially sales. Maybe you're divesting in equipment. So example would be like purchasing a new oven to make pizza. And the last one's going to be your financing section of the cash flow statement, right? Those are cash proceeds from either a loan or maybe equity capital, or it could be loan repayments or dividends, and which is also money going out the door. So that would be a negative. So that's basically the 3 construct of a cash flow statement. Any questions? All right, EBITDA, for the individuals that raise their hand on EBITDA. So what we're going to do is, this is a profit and loss statement. We just manufactured these numbers and kind of made them up. But $1 million of sales, and then down here you have your net income. So earnings for interest, taxes, depreciation, and amortization. So we're just going to basically dissect this. And so we have our earnings of 125,000. So that's down here. And we're going to add back the interest expense. We're also going to add back the taxes that were paid. And then we're going to add back the depreciation and amortization. Those are non-cash expenses. So you want to add those back. And that equals your EBITDA. And what that number is, we call it a rough measure of operating cash flow. That's really what that is. What is your business normally generating in operating cash flow? That's what our EBITDA number is a proxy for. Yes, the banks will sometimes do that. Is there a reason why you're asking that question? So why do you not include depreciation? Okay. So yeah, there's there's a number of reasons why depreciation might be excluded, and then that becomes a EBITDA metric. So one, you might be a service organization, you don't really have depreciation. Another reason is you do have depreciation, but as a bank, we may want to look at that metric because we know that as you depreciate an asset, even though it's non-cash, you have to eventually replace that capital asset. And so we're kind of normalizing what you could service either in debt service or other payments after depreciation, because in theory, you should be reinvesting into your business that depreciated amount, because you can't keep growing the revenues and deplete your asset base without some kind of refreshment of an asset. Any other questions? How can you know what depreciation is? I don't know the accounting rules for the software. So typically what we see is a financial statement that will follow GAAP, generally accepted accounting principles. And the accounting principles will guide you on what you should be recording for your asset to either amortize or depreciate. Now, there's differences between what you do taxes to the IRS versus what is GAAP. And that's a whole nother ball of yarn to peel away. So I can't answer that question because I don't know what the schedule should be to amortize or depreciate an asset such as software. But there's probably something, you probably just gotta look that up. Yeah. That was a good accounting question. Any CPAs in the room? Okay. Okay, so let's go through some real world applications for EBITDA and why we use it as banks and why it's important. So first one, it's a normalized cash flow metric, so rough operating cash flow, and it's agnostic to tax and capital structure. Okay, so what we mean by that is we want to see companies, and we like the EBITDA metric because it makes it apples to apples from company A to company B. Maybe company A is an S corporation, maybe company B is a C corporation, maybe it's a nonprofit. So when we're looking at a cash flow measure before taxes, we're kind of being agnostic to how much tax liability or tax payments they're going to make. And we're also being a little bit agnostic to capital structure. So it's before debt payments. It's before dividends, right? It's just an operating cash flow metric. So that's why we use it and we like it. Business valuation, multiple of EBITDA. So in the real world, there's a lot of businesses that get valued based on multiples of what your EBITDA is. So it could be a 5 times multiple, could be a 7 times multiple, maybe even a 14 times multiple. There's also different valuations applied to different sectors. Like in tech, you might be a multiple of revenue versus a multiple of EBITDA. In the stock market, you're typically seeing multiple of earnings, like a PE ratio. But for private businesses, a multiple of EBITDA is a very common metric. And I think that's something that you should understand. You should know what industry you're in. You should know what the multiples are. If you can source that data, you might have to do some Googling or pay for some services to get you that. But knowing what your business might be valued on a multiple of EBITDA, I think is helpful.
Hey, Kyle, quick question. So why 7? What is the value of that number?
Yeah. So the multiple is going to fluctuate. And I would just generally say that most multiples are going to land somewhere between 4 and 10 times because you're paying as a multiple of your rough cash flow measure. What we see of why the number goes up versus down, so more valuable, right? Higher, a 10x multiple, more valuable company. So generally, those are going to be more defensible cash flows, quality cash flows. So maybe there's high barriers to entry. Maybe you need all of these certifications. Maybe you have a patent on your products. Maybe you're in all these markets that nobody else is in, so you have a monopoly or a duopoly or something like that. So that would usually be a higher valuation. Also, if you're a larger company, you generally see a multiple expansion. So the bigger your business is in terms of EBITDA, if your EBITDA is going up, you might see a higher multiple. And the reason for that is bigger companies are usually safer. Smaller companies usually riskier, so they fail. So you start getting bigger customers, bigger EBITDA. That usually means you have more customers, more diversity of customers. So that usually will warrant investors to want to pay a higher multiple. Thanks, Daniel. Any questions on valuation? Yeah. How many percent? Okay. Mhm. Oh, yeah, great question. So usually the bank, we didn't plan that, by the way. Normally a bank on an operating cash flow is not going to lend more than 3 times EBITDA. So if you think about banks, we have to be stewards of capital, right? We have depositors, everybody's depositing their money to the bank. We have to be prudent and safe. So we feel that 3 times EBITDA is really our max. And even getting close to 3 times might be a little risky. And so it depends on the business, depends on how profitable it is and how large maybe the EBITDA is. But that's the number to kind of eyeball. Typically, I see something between 2 and 2.5 times EBITDA is usually a landing spot that we lend. And again, that's just on operating cash flow, because there's different types of leverage. If you're going to buy real estate, then we're going to look at more loan to value. What's the appraised value of the real estate? And we're going to have an amortization payment of 30 years or 25 years. And then we're going to look at your cash flow and what can you repay on that kind of debt structure. So this is purely a leverage metric off of EBITDA. And so what this tells you is, if we're going to lend 3 times and a business may be valued at 7 times, then you have a 4x of equity capital in that business. This is the same thing, right? So we look at it at debt and we divide it by EBITDA. That gives us actual leverage profile. And then we're going to use EBITDA as well and divide that by interest expense, so debt payments. So that's also what we use EBITDA for in the bank. Any other questions?
Thanks, Kyle. Okay, so next topic we'll talk on is proxy-free cash flow. So this kind of builds off of what Kyle was just sharing about with EBITDA. So proxy-free cash flow, it essentially contemplates additional major sources of our sources and uses of our cash, right? So to give you a little more granular number that you can feasibly work with. So this consists of a couple of different things. So again, we have our EBITDA number, and now we're going to consider cash taxes. Other items include distributions to owners, or on the flip side, you might have equity injection to kind of beef up your cash flow number. Unfinanced capital expenditures. So this could be, massive outflows of cash, or even maybe you're planning to sell any kind of capital assets. So that could be an inflow of cash. And then that leads us into our last point, which is other sources and uses, right? So this could be non-recurring cash flows, maybe legal expenses, right? So essentially the whole point of this is we want to take that EBITDA number, which is an easy, kind of number to calculate, right, off of our financials, and kind of tease it down into something a little more granular that you can reliably work with. So it's a more accurate estimate of your cash flow versus your EBITDA number. Very basic metric to calculate, easy, back of the envelope calculation, and essentially helps you to really get down to that true cash flow number so that you can reliably make budgets, estimates, and projections moving forward.
Any questions on this? Has anyone tried to use this type of construct to get to their proxy free cash flow? Yeah, it sounds like needing to solidify and try to model out maybe the scenarios of different growth might be something to do. And then you see how those numbers fall. And, you know, taxes might be a little bit more difficult to try to model out because you're ultimately taking a GAAP financial statement, and you also have to apply what you might realistically pay in taxes, which are not necessarily the same as what you show on your GAAP financial statement. But these other ones, trying to think like, you know, if you were a tech company and you had research and development, depending on where you allocate that expense, call it above the line or below the line, some other maybe large use of cash. But the spirit of this is that you get your rough operating cash flow metric, and then here are these other buckets of cash that go out the door, and you should be aware of those. You should be aware of what you need to spend in capital expenditures every year. Maybe you need to refresh some equipment every year, or maybe it's every 2 or 3 years, and you should be planning for that, either to borrow from the bank, or you have to inject equity, or you have to retain as much cash in your business along the way before you get to that year 3 where you have a large CapEx outlay. So this, you know, this is a fairly, I guess, simple, easier way to kind of get to a free cash flow number.
Real quick, just to carry on of what Kyle was just saying, I'm glad you asked that because I think that's probably something a lot of us might encounter along the way. So just hold that thought. At the very end of the presentation, we're going to go through a case study, and we'll kind of show you some tools. I mean, it's not going to be perfect, but at least just some tools that you can utilize on yourself or on your business to kind of help with that challenge that you had mentioned. Thank you. I noticed you had a question as well.
No, I was gonna say for like the unfinanced CapEx, one of the things that we've been able to do is like if you're sitting on a lot of cash, right? Other people would that we will prepay on of our like cloud storage. So for your like software product, like you can go to AWS or your product provider with you and just like pay for a couple credits so that if you know the revenue may not be as like steady or have this balance already at your cloud provider in order to.
Thank you.
Thanks, JP. All right, sustainable growth rate. This is the max rate of growth without having to borrow or invest additional equity. So just think your capital structure stays frozen. What is that growth rate that you can sustainably grow in the current capital structure? And you're basically using your internally generated revenue or your retained earnings. That's what the sustainable growth rate is. And this is something that if you are a high growth business or a venture, you need to know as out the gate what that growth rate is, because you can get caught. And I would recommend, we're only going to go over a year by year sort of example, but you really should be looking at your business every single month and what you expect cash to come in, what has to go out. And you can ultimately back into what your growth rate is. We're going to go over the formula. So you want a high SGR, you want a high sustainable growth rate, of course, right? The higher the growth rate is, the more that your retained earnings can fund future growth and you don't have to borrow or get additional equity. So it's common sense. You have high margin products, right? Very profitable products or services that you're selling. But you also need to manage your inventory, receivables, and payables well. That's where people can get caught. So that's a healthy cash conversion cycle.
Been on purpose because I want to understand this, because beekeepers do not have this is what it sounds like. It's a year-long cycle. Honey ends at the end of the year.
Yeah.
All the expenses are in the previous 9 months.
Yep.
Is that the opposite of this? Not really growing all. They are actually. Okay.
What?
Then their expenses continue to get in the red. But you still want food. So
yeah,
is this the opposite?
Well, I wouldn't say that this is the opposite. I would look at it through a different lens of the constraints of your sector or industry kind of dictate what your cash conversion cycle will be, right? You can't force a plant to grow faster, right? If you were a farmer growing trees. So there's just certain realities of your cash conversion cycle, and your cash conversion cycle is long if you're having to invest in, I guess, the bees to make honey. Yeah, so then your cash conversion cycle is very long. And so that's not abnormal industry, right? So that's the normal industry. So then when you look at your sector, you're going to have industry conflict. And we're going to go over this, like in manufacturing, or if you're a construction company, there's going to be a range of days of inventory or payables that things kind of fall in. So you should be comparing yourself to that, and then you should be trying to dip and tuck where you can. And either things can be accelerated, so the quicker you can make your cash conversion cycle within the confines of your industry is what you should be striving for. Of course, a tech company that has different products and services, right? They're going to have high SGR. You're in a different space. Takeaway is that you have your cash conversion cycle. It is what it is. There's certain things that you can't necessarily change, like you can't make the tree grow faster, but once you have that reality, you try to figure out where you can improve, and then that will help you with what kind of capital you need, right? So you don't want to borrow a short-term loan if your cash conversion cycle is very long, so you need more permanent financing. So you have to match those things up, or your equity capital investors also need to understand that this is the reality of this type of industry. You have to invest up here. We don't monetize and harvest until 24 months later or something like that. Yes, it can. It absolutely can, because then you might be generating more free cash flow, right? So, and it's always about the delta from one year to the other. So when you said tighten up receivables, yes, because that's collecting cash. Tightening up payables, well, in theory, you might want to extend payables and pay them later. And we're going to have an example of that. Okay. So this is the sustainable growth rate formula, which is your retention rate times your return on equity. Retention rate is basically what you're retaining in the company. So it's 1 minus the dividend payout ratio. We're not actually going to go through a mathematical like example. We're just going to give you the formula and kind of show you what it is, so you can figure that out. But conceptually, the point about this is the more that you retain in the business, if you don't pay out any dividends, then in theory, right, the formula will say your sustainable growth rate will be a little bit higher. If every year you're pulling money out of the company, then you're starving it of cash, which would have been used to fund future growth. Yeah, you can grow into bankruptcy. So that's a takeaway here. You grow too fast, you might get caught where you don't have money to pay your employees. Maybe you ran out of money to pay your vendors because you didn't collect fast enough. So that is something that you need to be aware of.
So Kyle, real quick, I know you mentioned tech companies earlier. Can we talk about that? Like, why is it that tech companies tend to retain a lot of their earnings versus paying out, say, dividends?
Yeah, good question. That's because tech companies are usually high growth companies. It's capital wise, it's not efficient for them to be dividending money out to the shareholders when that money can be used to grow the business, grow their net profit line, grow their EBITDA line, which then expands the multiple, right, or increases the market cap value of that company, which a shareholder will want. And so that's why tech companies that are growing will never. Although Facebook just paid a dividend or just announced one. So they got billions of dollars of cash, and they don't have to worry about capital. Any other questions on this? All right, cash conversion cycle.
Perfect. So cash conversion cycle, I know it's perfect timing, you just touched on it. Quick. Mm-hmm.
To be paid annually for the
Yeah, monthly. Usually monthly. Sometimes you might get a quarterly schedule a payment. But yeah, a bank will usually require monthly payments of interest. That's a very customary requirement. You're not going to be much deviation from that. We might see bigger companies get away with quarterly payments of principal and interest, maybe even semi-annually, but those are very rare and few and far between. So for purposes of this class, it's monthly payments.
Good question. So we're talking about the cash conversion cycle with your B business, right? So what we're going to do is just kind of go high level. I know all of you are probably pretty much aware of kind of how this works, but we always feel like it's easier to kind of just set the base first before we kind of dive into, some of the more granular details. So just real quick. So inventory days, right? So that's essentially the average number of days that a company has, that their inventory will last, right? So essentially we want to generate quicker turnover, quicker cash, right, back to our pockets. Next up, we have our accounts payable days. So again, this is really helpful, right? Essentially, this is the credit extended from our suppliers, our vendors to us as a business, right? And it's the average number of days that it takes us to pay those invoices, right? So longer is essentially more beneficial to us. It's a longer period of time before we have cash rolling out of our pockets. And then last up, AR days, right? Accounts receivable days. Average number of days that it takes the company to essentially collect payments from our customers, right? So again, we want to compress that. We want it tight. We want to collect payment from our customers on invoices, perhaps as quickly as possible, right? Quicker cash inflows, better for us, right? So you'll see right next up, there's a quick pictorial, right? Just so you can kind of get an idea of where we're going with this, right? So we have the inventory days, first thing we talked about, AP days right on the left side, and then the AR days. And then between these cash inflow events, right? Cash into our pockets, and then cash outflow, cash out of our pockets, we have that cash conversion cycle, right? So essentially the goal, the whole goal, right, is we want to really compress that cash conversion cycle as much as possible to really improve operational cash flow for our business. Any questions on this slide? I know there's a lot going on. You guys have anything you want to talk about?
I don't know, maybe we should just, kind of walk through the timeline. I know everybody can see it, but, you just the inventory, and then you kind of move forward in time. And the cash was paid to your supplier, right? So that's your cash out. And you eventually sell. You eventually sell what you made, and the invoice is sent. So you didn't collect cash yet. And then you finally get to the end where the customer paid on that invoice, and that's the cash in. So what are other expenses that are probably key to a business that's not in this cash conversion cycle?
It's a good question. So something that I think all of us will encounter with our businesses is payroll, right? Got to pay our employees, make them happy. So payroll is a very interesting fundamental concept here because as Kyle had mentioned, right, we're not capturing it with our, our base primer of the cash conversion cycle, but it is something that we have to be mindful of considering it's arguably the largest expense of our business. So not saying don't pay your employees, right? Like make sure you pay people, pay them on time. But essentially with payroll, right, there's ways that we can help to essentially beef up our cash conversion cycle, really make sure that our business maximizes our cash as much as possible. So for example, ASB, we pay our employees weekly. But if you wanted to, essentially help with your, your cash retention, perhaps go from a weekly schedule to a bi-weekly schedule, right? To essentially ensure that you're not having these constant recurring flow or outflows of cash from your business, right? So little tricks that we can implement that will essentially help to really tighten the cash conversion cycle, ensure that we can retain as much cash as possible, and just being a little more mindful and strategic with, the different choices we're making.
Then on your invoicing, right, for your receivables, you might offer incentives for customers to pay early. See that, at least accounting, right? They go over it like 2 net 10, or I forget what those terms typically are, but there's also incentives, right, to try to get cash collected sooner, or maybe you require deposits, right? So we see that. Okay. Any questions? This is what we feel like sometimes. All right. Yeah, everybody feeling all right? Good. Okay. So we're going to continue on cash conversion. It's probably the most important aspect of what we're teaching today.
Perfect. So again, we just went through, right? So we're talking about the cash conversion cycle, right? Essentially converting inventory, paying our vendors as extended, extend those terms out as much as possible, collect from our customers as quickly as possible, right? Making sure we're really beefing up our cash conversion cycle. So next up, we're gonna kind of go a little more deeper into the essential topic. Next. Right. So we want to collect receivables quicker, and then quicker than we're paying out, right? So here's a good example. We're talking about a shoe sale. So say we sold a shoe for $100 of revenue, it's $100 on the books, and then we collect that $100 5 days after we made the sale. And then on the other side, right, we have our actual input costs, right? So to purchase the shoes, $50. So that's our inventory, and then our our accounts payable days. And we're paying the manufacturer about 10 days after the actual, the actual chart or delivery of the product. So you can see, right, there's a 5-day delta, and that 5 days of difference between when we're collecting from our customers as opposed to when we're paying our vendors. That 5 days essentially is 5 days of free borrowed cash, quote unquote, borrowed cash from the vendors, interest free from the vendor, right? So essentially we're getting the cash first before we pay on that bill. So little tricks and tips that we want to kind of just be mindful of and implement so that we can really maximize our own cash position as we kind of contemplate that free cash flow, in our different businesses.
Who collects a shoe payment 5 days later? I'm just we might change that example for next year. Well, if you accept credit card, then it's going to be pretty instant. Yeah, so we're trying to use examples where there are timing differences, and when companies get bigger and stronger, and you have purchasing power, they can push, right, their vendors around a little bit, and they start really taking advantage of this working capital cycle, and they collect quicker, they pay a little bit later, right? So then they're using sort of interest-free money, and those are competitive advantages for some companies because your cost of capital is ultimately translated into how profitable you're going to be, and if you don't have to borrow and pay interest, that's more net income. All right, so we're going to do a case study, but we're going to take a break after we go over this. So Kahlo Confectionery, startup candy business offering tasty chocolatey treats for the holidays throughout the year. Our competitive advantage is that chocolates are made from ultra premium Swiss chocolate, utilizing milk from European cows. We, when you're up late at night putting this together, you realize you call it a Hawaiian business, and we're using Swiss European cows. So, you gotta give us a. So anyway, the company secured $520,000 in investor capital to get the business off the ground. Expected to turn a profit within the 3-year time horizon, so fairly short. I actually think they're profitable year one. The founder will use the initial investment to locate a space, purchase equipment, and hire staff, craft a specialty recipe, and produce chocolate, which is your inventory, create a website, and advertise. Here's just a breakdown of your sources and uses. So we're gonna pause here, take a 5-10 minute break, and then we're gonna get an Excel sort of calculator spreadsheet up, and we're just gonna walk through this example of growing a business. What does that do to your working capital, cash conversion numbers? That'll be we'll finish after that. Okay.
Cool. I guess we'll take a break now, and then
Yeah, come back. Okay. All right.
Perfect. Thanks, Kyle. All right, so we're just going to kind of go through this really slowly at first, just so that you guys can kind of get a lay of the land. And then as we kind of go year over year, we'll pick up the pace a bit. But just to kind of first start off, it's almost essentially mirroring what you would see on a normal P&L, right? Income statement. So we have our revenues, first founding year, right? So founding year revenues, 500,000, cost of goods sold, 300, kind of isolating that gross profit of 200,000. Wanted to point out that margin, right? So 40%. So just kind of plant that in the back of your mind. It'll stay out there, but as we move through the next couple of years, that'll be kind of a key driver as we kind of go through some of our explanations as far as like what we're seeing at the very bottom with our cash inflow outflow situation.
Sorry, the folks on Zoom were still looking at the PowerPoint.
Thanks, Andy. And then Kyle, do you mind if we hide the little floater?
Oh,
at the
yeah,
bottom?
okay.
Perfect, thank you. Okay, so now we got our gross profit taking us down to EBITDA. So essentially what we're doing is we're doing a bottom-up approach, right? So net profit is our starting point, and then rebuilding in all of those different items, right? Interest expense, taxes, depreciation, amortization, bread and butter, basic stuff, leading us to our EBITDA final value of 111,500, right? Again, listed the margin, and we'll kind of talk on that on future periods, but just kind of plant that in the back of your guys' mind. All right, so moving down to the estimated free cash flow. This is what we were talking about in our presentation with the proxy free cash flow, right? So kind of taking that high level EBITDA value, real easy to calculate, and then drilling down to something a little more specific that we can work with towards a truer free cash flow number, right? So we have our EBITDA, taxes owed, distributions. There weren't any distributions taken in year one, and then some CapEx of 500,000. Just a couple of notes. So taxes owed, we kind of just built a basic P&L on the side when we were modeling this out. And taxes would be just a basic 21%, corporate income tax. The 500,000 capital expenditures, because we have a chocolate manufacturing company, it's just the anticipated initial startup cap, right? You have machinery, you have packaging, et cetera, et cetera. So that was where the 500,000 value comes from, which essentially leaves us at a cash flow deficit of 407,715. So somewhere along the way, we're gonna have to raise that capital, whether it's from debt, equity, or maybe even operational performance. All right, so we'll keep going. So over here, row 28, you have a pro forma debt service. So this would layer in any kind of debt payments, capital leases that we might have. So because we're in the founding year, we just use startup capital from investors, nothing from the banks yet, unfortunately. So we don't have any debt service. Row 34 takes us to our final working capital value of 407,000. So moving down, right? So this is essentially what we're looking at as far as our isolated kind of cash flow number from operational performance, right? Okay, now going down to row 36, our working capital sources and uses. This is where the cash conversion cycle comes in that we were talking about. So we have our AR, just estimated 50,000 AR, which leads us to our AR days. And then we also layered in an industry average. The reason why is we want to kind of like Kyle was saying earlier, right? We look at our competitors, see what everybody else is doing, and then kind of compare our own performance to see if there's potential opportunities to either tighten up AR collections, maybe beef out those AP days, et cetera. Right, so we have 50,000 AR, 92,000 in inventory, 30,000 in AP, which essentially leads to a cash conversion cycle of 67 days. Now, as we look at it, just a quick study, we can see our AR days, inventory days, and our AP days comparative to the industry are a little higher. So pretty helpful, right? We can kind of recognize that there is potential opportunities for us to maybe beef it down a little more to essentially help our cash situation. I'll pause. I know that was kind of a handful. Any questions so far? Is everybody okay? Perfect.
So we, we're obviously trying to condense this just into 1 year. If you're truly a founding year, you want to look at things on a month-over-month basis at minimum, right? To really see how your working capital is moving in terms of how fast are you collecting, right? If it's 60 days to collect, what timing you have to pay your vendors. Those are really those cash inflows and outflows that you need to isolate because you're only going to have a certain amount of cash and that could be used up very quickly based on your working capital conversion cycle. The question for you is,
Ooh, good question. Okay, so, and we'll share this with everybody after the presentation, just so you guys can have something tangible to take with you after the presentation, just to kind of help with the businesses. So you can see, actually, would you mind clicking on the top right? It's 85, can you? Yeah.
that one?
So what Kyle and I did was we pulled this report. It's from a system called Vertical IQ. So essentially what it provides is a high level synopsis of the industry, right? So it provides kind of opportunities for the industry, competitors, kind of who are the biggest players in the space. And then it also provides comparable values. So if you go down, you can see over here, kind of lists out what you have. So you have trends, working capital, which is what we're talking about today. And then also different items, right? Banking products that we could offer. So it's helpful for us too, but also for business owners and entrepreneurs who are considering going into this industry with your own respective businesses. So if you keep going down, it's kind of towards the bottom. Sorry, I should have got the page.
That's all right. We're looking for the AR days.
Yeah, I'll point it out when I see it. Keep going.
And so, you know, your banker can provide something like this to you based on your industry or NIAX code.
Keep going.
Sorry. And this is what we do look at. When we look at a firm, we're going to look and compare it to the industry. Sorry, let me just get to where Daniel.
No, you're fine. Fine. This is
Keep
actually
going.
helpful to kind of show you guys like what we're talking about with comps, et cetera, industry analysis.
Is it-
Sorry, quick question. So you said your banker can do that for you?
Yeah, if you have if the bank has access to industry reports, you know, you can ask them to pull an industry comp set for you and share that with you.
Okay.
So a relationship officer, so it might be a business banker in the branch, or if you have a commercial loan officer or relationship officer assigned, it'd be one of those individuals. And if it's anybody from American Savings, please let me know if you don't get an answer. Yeah, and we will help you. Okay, sorry, let me just,
No, you're good. You're good. Keep going.
I'm just gonna Control F.
So again, just examples, right?
close.
Gives us examples of pricing for CapEx products, that type of thing. Here we go, right here. Right up top. So these are the three areas specifically that we're honing in on: your inventory days, receivable days, and payable days. But again, it's very helpful, right? Because then you also have like towards the bottom on the income statement section, you have margins, right? Gross margin, salaries. This is what we were talking about earlier, right? As far as like maybe controlling that salary costs, inflow, outflow. And then it also goes into other specific items. Rent costs, of course, you know, Hawaii is a little more expensive, so that's take it with a grain of salt. However, this is the industry, so it's really helpful to at least provide you a starting point, right? So we have all of our inventory days, receivable days, payable days, and that's essentially where we sourced that data value point that we have in our own calculator that we constructed out. Go ahead. Thank you. Yeah, so all these days in red are essentially sourced right from that specific document. Perfect. Okay, so just kind of bring everything together, kind of tie it back to the whole purpose of like, what are we doing, right? Why is this important? We have our working capital results. So working capital need, that 112,285 is essentially coming from the top. And then this cash flow from working capital is also taking into account the working capital. This is what we were doing earlier, right? So that EBITDA, remember how we went from EBITDA to kind of that free cash flow, proxy free cash flow. So you got the 407. And then combining that is showing us, do we need cash or are we good, right? Do we have a cash surplus to kind of provide payments for any products, in any inventory, payments to vendors that we might have? So you can see the deficiency right now we're at is 520. So considering that, we're going to need to raise some sort of capital from somewhere, right? So like we mentioned, is going to be equity injection from potential investors, from ourselves, or conversely, might it be a debt injection from, you know, from a bank loan, right? So what we're going to do, we're doing equity injection from investors, and then that ties back to our initial slide towards the very end of our presentation where we showed that the sources and uses, right? The 520. Any questions? Perfect.
Is anybody curious about the working capital need? I mean, you can see the formula up there, up here in the bar, but value, account receivable, inventory, and payables. And so it's summing the asset side, netting out the liability. So, and that's that number that has to be financed or equity. Okay.
Thanks, Kyle.
So when I go to,
Yeah, if you can uncover the next column, so column D.
Okay.
Okay, terrific. So this is kind of where we'll progress along, and again, it's going to kind of pick up a bit. So if you have any questions, feel free, just raise your hand, let us know. So we're going to the second year, right? So we're seeing revenue growth of 2x, right? So we're going from 500,000 to $1 million a year. We're kind of stable, stable gross profit margin of 40%. And then as we kind of go down, right, we're seeing that EBITDA margin compressing. So kind of weird, right? We just grew our sales by twice as much, and yet we're seeing EBITDA compress. So just kind of think about that as we move towards kind of the bottom, like that synopsis, the overall synopsis that we go through. So as you continue, kind of similar, right? We got the taxes owed. Again, no distributions claimed in 2021. So we're kind of going for that high growth, kind of segment. And then CapEx is kind of reducing down to only 50,000, right? So we got the bulk of what we needed in year one. Now we're just kind of doing smaller ancillary type purchases, maybe like chocolate machines, et cetera. No question. Oh, good question. Okay, so distributions, essentially as the owner, right? You have the right to essentially pull money from the business, pay yourself, right? And this isn't payroll. This is just straight, just from your equity, right? So if you decide like, hey, we have $1 million in the bank for the business, and I want to take a distribution. It's just almost like dividends, right? You guys do any stock investing? Dividends, right? Like it's the best, right? You get paid, every quarter, et cetera. It's essentially what it is. So early startup companies, like Kyle was mentioning with tech, right? They tend to not do dividends because they really want to hold all the money within the business to really promote growth. And that's kind of the model that they're taking here in our example, right? It's not a tech company, it's chocolate. However, we really want to encourage the growth of the business in the starting years. Good question, thank you. All right, so you can see at the very bottom, comparatively to year one, cash flow before working capital, we're positive, right? So this is a positive for us because now we're not having to worry about going out and seeking cash. It looks like, at least on the surface, before we get to our working capital need, that we should have enough money, additional cash flow surplus. So continuing down, we can see AR, inventory, and AP days. Relative to the previous year, there's improvement, right? So this one's down about 7 days for your AP, 6 days for inventory, and then flat for AR. So maybe the AP days might be causing some issues because like we mentioned earlier, right? You want to extend that as much as possible because it's essentially free quote unquote credit, it's borrowed money for the business. So we'll see how that impacts us as we continue down.
And just or like accounts receivables, well, it's kind of intuitive. It doubled in value because we doubled our sales, right? So we tried to logically also construct these numbers that made some sense to what reality. And then on the payable side, the number of days compressed from 37 down to 30. And that's why this didn't necessarily just double because the days compressed. So we were paying the faster. And maybe in reality, the vendors were pressuring you in year one. Hey, pay me faster, pay me faster. You're 7-8 days later than the industry. So maybe that was something that you decided, okay, I need to keep these guys happy. Otherwise, I might change my terms and then my gross profit margin of 40% might be impacted. So sort of minutia of reality of running the business. Sorry.
No,
Any
good points.
questions?
Awesome, thanks, Kyle. That's helpful. Okay, so again, kind of tying everything together, right? We have our working capital need of 119,715. It's kind of like what Kyle was just mentioning, right? Maybe because we have additional pressure from our vendors paying faster, that's actually creating some impact on our working capital need, where we're seeing it going up about 7,000. And then conversely, cash flow before working capital. So this is that proxy free cash flow, that EBITDA number that we were massaging towards the top. Much improved, right? Year over year. So we went from a deficit of 407,000 up to cash flow positive, just under 102,000. So collectively, we're still in a deficit, right? 17,785, where we need to find some sort of source of cash, but better than year one, right? So we go from 520 to this year, we're going to need some sort of an injection. Again, we're going to call on investors to contribute an additional almost 18,000 to the business.
And this shouldn't be a surprise. You grow 100%. That's a very high growth rate. So you're likely going to need some additional capital to support that growth. And up the bulk of that was really in your working capital number. And so if we scroll back up, it's kind of accounting 101. It's the delta, right, from the 50,000 of AR to the 102,000. That's a use of cash. And same thing for the inventory, right? The delta going from the 92 to the 180 use of cash, and then the 30 to the 50 was a source of cash. Sum those positives and the negative, you get to the 119,000. So next, ready for the next year. Okay,
perfect. All right, so year 3, 2022, we're going, and again, growing, not as aggressive as year 2, but we're growing again 50%. You can see COGS remains stable at 40%. So overall, not a bad year, right? We're continuing to grow, keeping costs under control. You're seeing, continued expansion for the business in a relatively short period of time. So continuing down with our EBITDA calculation, again, it's no interest expense because like we were doing in the previous years, right? We're taking cash from investors, nothing from the banks. So, obviously nothing owed. Taxes continue to remain the same. It's at stable 21% year over year. And then we also have our depreciation cost, which has been in there for that initial investment, right, that we made with the canning machines, et cetera. So overall, we can see the EBITDA is growing, right? The total numerical value has gone from 187,000 the previous year to 270,000. But again, looking at that margin, kind of curious, right? Because we're going from a higher EBITDA margin in year 1, and it's slowly but surely it's compressing. And we're seeing that at the bottom, right? As we kind of work through our working capital need and cash need. Okay, so continuing down, we can see our estimated proxy free cash flow. Again, starting with the 270 EBITDA value, taking into account taxes owed, any kind of additional CapEx, right? So we're seeing relatively stable CapEx, 50,000 a year. It's not as bad as year 1. But something to note is in row 24, we do have that distribution. So investors felt, hey, we're on track. We're doing much better. You can see with our EBITDA value, company is growing from positively, right? Positive free cash flow. So let's take some of that money and reward ourselves. So we pay ourselves 25,000. So that brings our cash flow before debt service to about 142,500, right? So pretty positive, right? You're seeing year over year trends, right? You're going from a negative 407, and then year 2 or 2021, 101,000 to now year 2022, about $40,000 more. So exactly what investors would want to see, right? So go ahead.
So just to pause, for illustrative purposes, we made capital expenditures pretty simple, 50,000 in the first year after founding. You have your core asset base that you purchase for all the equipment, and then maybe these are additional ancillary equipment, or maybe repairs need to be done and augmented, whatever. But in reality, these are usually chunky, right? They don't always happen every year, business. And as you grow, this number also should, in theory, increase as your business grows and you're doing more revenues, you're utilizing your asset more, or maybe you need additional equipment. So we just kept it simple at 50,000, but calling it out in terms of what happens maybe in reality, but it's really unique to what your business is and what your capital needs are.
Thanks, Kyle. All right, so kind of taking us to that final value, right? Again, no debt, so the cash flow before working capital remains stable, right? You're seeing that growth. Okay, now diving into our actual working capital needs, right? AR, AP, inventory. Again, we can slowly see an upward trend, which is to be expected, right? Because as our sales are growing, we'd expect these amounts to slowly, start to expand a bit. So we're going 150, 270 on the inventory, and then 80,000 on the AP. Looking at the days, you can see, essentially trends remaining stable, nothing too out of the ordinary, although there is some improvement on the AP days. So now we're going up above industry, which is promising.
But you mean erosion?
Or sorry, erosion. Yeah, sorry.
Our vendor's a little late again.
Little late, yeah. So in totality, as we go down to the very bottom, just kind of analyzing working capital and then free cash flow from the business. It's a positive, right? 34,500, right? So working capital need and cash flow, or working capital need and the cash flow before working capital essentially is covering. So the business is generating enough cash flow to cover any kind of working capital need and essentially generating a surplus of almost $35,000. So this is promising for investors, in addition to them finally claiming some sort of a distribution, rewarding themselves with 25,000 this year. So this is kind of the projection, kind of the trajectory, if you will, that we want to see the business moving towards.
So we started with just an assumption of zero cash, because we just want to show you the cash need, right, or the cash surplus, really just starting zero. In a real business, you want to be looking at, okay, you're going to have cash in the bank, and you need to be looking at that again month by month and what's happening to your working capital conversion cycle, and when are you potentially impairing that cash balance, right? So, this is sort of educational in that we're just compressing it by a year and showing from a zero cash balance to what happens. And As we get to year 3, the growth rate has slowed. We went from 100% to 50% growth. And that does translate into a slightly lower working capital need, which makes sense. If you had flat growth, your working capital need in theory shouldn't change much unless you're changing the number of days of AR inventory or payables, then that will change what this value is. But if you held everything constant and you had 0 growth, this number would be 0.
Any questions? Are you okay so far? Okay, perfect. So let's go into the final year, 2023.
We jumped up again. Okay, well,
Yeah, so again, it must be a pretty promising year because this is really good growth. So now we're seeing twice as much money as we made in 2022. So growing at 100% this year. Again, COGS remaining stable, which is really promising. It's telling us that we're controlling, any kind of supplier costs, possibly even combating inflation as we've, been encountering lately. So our margin remains, pretty stable at 40% for gross profit. Moving down to the EBITDA calculation.
we did keep this constant on purpose. But in reality, as you do more business and you have more purchasing power, maybe you could expand gross margin. Maybe your vendors will be like, hey, I'm going to buy more from you, sell it to me at a lower cost.
Good point. Yeah. All right. So EBITDA, we have, sorry, I should have pointed this out earlier too. So from a profitability standpoint, this is also a good indicator of showing kind of the growth of the business, right? We're seeing net profit listed at 72,000, almost 132,000 in 2021, 198 in 2022, and now we're at almost 364,000 or 365,000. So pretty good as far as the profitability of the company, right? So this is a profitable company. It's exactly what an investor would want to see. Something we added in 2023, some interest expense, and you'll see it towards the bottom when we calculate working capital, but there was an additional need for some funding, right? So now we're injecting some debt into the mix. In addition to calling on investors, now we're going to go call on banks. Taxes, again, stable, 21%. Depreciation, exactly what we've seen year over year, and then no ammo. So essentially, EBITDA is 500,000. Not bad. Again, though, something to consider. Look at the margin, right? So there is some slight EBITDA margin compression. Might be an idea as to like why, right? Maybe we want to dig into that as we analyze the overall business and potential opportunities. But overall, promising. 500,000 EBITDA it's not a bad year at all. All right, so proxy free cash flow, kind of the same things we've been seeing, right? So taxes, distributions, CapEx. So potentially investors saw, hey, promising growth. We have a great EBITDA number. Let's just like keep the ball rolling, right? So why take out more cash? So no distributions this year. You'll see again 200,000 in CapEx. So like Kyle was mentioning earlier, that can be lumpy, right? So maybe one of the machines broke down, or maybe we're seeing such promising growth. Let's buy another one of those gigantic machines to really just fuel the fire. So overall cash flow before debt service, 203,000. And then considering the fact that we just injected some debt into the mix, we're going to have our loan payments that we have to cover. And then we have this value over here, DSCR, so row 32. So this is a really important equation that we wanted to highlight because this is what we use in our own practice every day over at the bank. So debt service coverage ratio essentially is saying, okay, based on how much cash flow the business is generating, how much of that cash flow can they cover, or how can they cover debt payments based off of that cash flow, right? So essentially the 6.55 is saying they have 6.55 times the number of debt payments in the form of debt-free cash flow, which is exactly what we want. It's a very, very strong company. Anything to add, Kyle? Perfect.
We'll get down here.
Okay. So one more thing to point out, row 34, so that cash flow before working capital. You'll notice, unlike the previous 3 years, that 2023 value also deducts from your working cap or from your free cash flow, it deducts the debt payments. So just something to consider, right? Because as much as debt can be supportive, it is also taken away from your cash position because you're obviously having to make whether it's monthly, quarterly, yearly, or semi-annual payments, right? Okay, so moving to working capital, AR, inventory, AP, again, continued growth, which is to be expected given the pretty significant growth of the business. Days compared to comparables is looking pretty stable. Nothing too crazy as far as changes other than the inventory. So as we continue down, we'll see the impact of that change in the inventory days in the form of our working capital need. so that 410,000. So because we had such a significant change, 10 days of inventory days that rose from 2022 to 2023, it really beefed up the working capital need to that 410,000, which caused the which caused the capital deficit, right? So we're at a $206,810 deficit, which essentially means that we need to go and borrow $172,000 somewhere, right? Whether it's cash injection from investors or debt, which is what we ended up ultimately doing from a bank. Any questions on that? I know, sorry, that was a lot, but all good.
Yeah, so great. It's a seasoned business. It has multiple years of history, although it's been high growth. It has profit for 3 years or 3 years, maybe actually 4 years. And then your EBITDA line was it $500,000 of EBITDA?
Yeah.
Right. So if you back to that other slide, bank might be willing to lend up to 3 times that number, 1.5 million. So this is a fairly easy loan to make to this kind of business. So from an investor, you would want to use that leverage instead of injecting more equity, because now your return on equity can be greater if you don't have to put in more equity because you're going to leverage debt. And you know, this is a profitable, it's a cash flowing business. So from a lender's lens, we're going to look at this 6.5 times, and that's really strong. So that should get you good terms on your loan, low interest rate, right? So if your cost of debt is, well, today it's maybe more like 6.5%, 7% for a really good company. If that cost of debt is lower than the return expectations of the equity, then that's advantageous to your company.
Yeah, think about at the bottom, debt or equity. So we need cash from this business, right? We need to come up with $172,000. So you as the owner have to decide, do I want to give away ownership of my business, or would I rather just like take out a loan? So that's part of the decision-making process as the owner of your business is, would I rather own less of a bigger thing and give away equity, or go to the bank, get some debt, and now I have to service them? But because we're doing 500 grand EBITDA, we're an easy loan to make for the bank.
Now, you could be an owner that has tons of liquidity and tons of cash, and you don't need outside investors, and you can inject the money and be debt-free. There's nothing wrong with that. It's just, what is your risk appetite to take on leverage, which can help increase the return on equity returns, because then you'll have a lower equity base or the same equity base, right? You're not going to add more equity to the capital structure. So, you know, using debt can be very advantageous for your equity returns. Another way to think about it is like when you have a home, right? You take a mortgage, it's 80-75% of that asset, right? And you have your equity, which is 20 or 25%, and then the asset goes up in value. Your return on that equity can be huge, right? Because most of it was debt and your equity was this smaller portion, and then the asset value increases and your return on that equity is pretty significant. So that return is only significant because you had all this debt in there. If you paid all cash for your home, your return on equity is going to be, you know, a lower percentage.
The ones that has cash, it's the way cheaper option.
So yes and no. The return on equity requirements are typically going to be higher than the cost of debt. However, if you're a new business that's starting, you might be going to a mezzanine lender or a lender that's going to require a higher return or a higher interest payment on that debt, right? It could be 15%, could be something pretty high. So when the business matures and it graduates to a point like this, and you want to borrow from the bank capital will be pretty much your lowest cost of debt. And then that's when you're really efficiently using leverage in your business to maximize return on equity. Yeah. So I would say the mission statement overall of a bank, in my opinion, is to help the business become debt-free. I mean, to really own their business and not have to borrow. Using debt and leverage is a very good tool to get to the growth and accomplish the dream, right? Because a lot of owners, "Hey, I want to buy this equipment, I need to grow, I need to do all these things, and they don't have the equity capital to do that, or maybe they don't want to give away ownership of their company. So then you come to the bank, and if the numbers, make sense, then that's something that we can do because we're not going to have ownership of the company. But, from a mission standpoint, we aren't in the business to want to leverage up companies, right? That can be dangerous and they can be foreclosures, and that's not what the bank is in business for. We want to see businesses thrive, succeed, hire employees, right? And all those customers create future customers for the bank. Yeah. But circulating capital is absolutely a necessity of what we have to do. Otherwise, we wouldn't be in business, right? So we take depositors' money, it's safe, and we try to lend it out very prudently in a safe manner as well. Cool. There's another row.
Yep. So if you can uncover that row and then the row right next to it and row R.
Okay, you know what? Let me collapse maybe
Oh, yeah.
these guys so it's not an eye test. Hold on here. So what do we do here?
Yeah, or if you can also collapse the row right above row I. Yep, that one right there.
That one?
Perfect. Yeah, okay. So last thing we're gonna do, we're not gonna go too granular on this like we did with our 4-year exercise, but what we wanted to show you with this specific calculator, as well as the subsequent one right after this, is that we also constructed, and what we're doing is we're gonna give this to you guys, right? So just so you have something tangible, something you can take into your own businesses, kind of play with the numbers, see how everything flows, and then see, hey, maybe there might be potential strategies or opportunities that you can implement to really help cash flow, help profitability, et cetera, right? So this is just another one of those tools, right? This is an example. Yellow cells are values that you input. So for when you take it for yourselves, just feel free to delete it, right? And then you can fill in these red cells, the inventory days, AP days, et cetera, off of the comps that you find for your own industry, right? This second calculator that we have here is just to give you an idea of different industries, right? Just so, service industry with offices of lawyers, bakeries, there may be high inventory. And then we also have single family construction in column L, which might be, kind of a little more service related. Maybe they might have to have a massive CapEx in the form of like tractors, that type of thing, right? But just for examples, but also it gives you an idea of going either backwards, right? If you want to implement, again, yellow cells are values that you input. If you want to put in specific sorts of days that you want to chase for your business, what types of numbers are you trying to hit based off of revenue, cost of goods sold? And then conversely, right, if you have a specific target value for AP, AR inventory, what type of days can you anticipate based off of your revenues and cost of goods sold, right? So again, just another tool to kind of project out budget, because budgets are really hard, right? We can't really forecast the future, but as much as possible using what data we have, you can use these tools to really help. And then last thing I wanted to show you guys, column R. Would you mind opening that one up for me?
Oh.
And then if you can scroll all the way up to the top.
Oh, to the top, okay.
Yeah. And then maybe we can collapse these. Oh yeah, perfect. So last thing I wanted to show you is this. So Kyle and I put together some resources, again, takeaways that you can implement with your own research. And these are really helpful guides for comps, right? So whether it might be industry research, maybe looking for comparable values with like AP, AR, et cetera. These are good resources, specifically the last one. So the UH Manoa database has a variety of different resources, including Mergent Online. I think they have IBIS World, which is also another great resource, but it's something that's available to us. Might as well use it for free. Top two, or second one, Vertical IQ, that might not necessarily be available to you, but that's just the tool that we use, right? So if you have a banker that you're working with, that's what you want to ask them for, right? Just ask them for the Vertical IQ report. They should know it. And then lastly, the NAICS search tool at the very top just kind of tells you like, what is the specific code for my industry if you don't know it? And then that code that's pretty universal, whether it's with taxes, banks, et cetera, you can utilize for your research. So just some tools that you can take away after the presentation, for your own research as well. Anything else?
I heard you say that IBIS World is a part of the UH
It is.
Manoa database. Okay, so Kurt, that IBIS World is the same, not the same, but a competitor to Vertical IQ. And so that industry comp with all the ratios and the financial metrics, IBIS World will have something like that as well for whatever industry or NIAX code. You search it and it'll pull up that data set for you. So that could be, I guess, accessed through the UH database.
Yeah. And does everybody here have like a UH username, UH access? Okay, perfect. If you don't, I'm sure, can somebody partner with Darren? These are very powerful resources. We pay thousands of dollars for the resources at the bank, but they're available to you for free. So heavily encourage you guys, like, take advantage, because it's a great resource.
Okay. I noticed this was 142 days for the industry for, which makes sense, right? Single family housing construction. I don't know if there's the B's in IBIS World or Vertical IQ, but this is what we talk about when you look at your industry and you want to see what those number of days are. Well, that was it. That was our cash flow class.
All right, hey guys, I'm our entrepreneur in residence, and I see a few familiar faces. Okay, so this is a little bit hard because some people have seen some of this stuff before, but maybe it's helpful. Who is working on like a real product or idea already? 1, 2, 3. Okay, more than half. All right, who entered the UH venture competition? All right, perfect, great. All right, so this is really a couple things. 1, because we have a limited amount of time, and 2, because a lot of you have heard this before. We're going to not go into the extreme depth, but I'm really focused on the scoring criteria. Okay. So for those that aren't joining, I'm sorry that we're going to focus a lot on the venture competition, but it gives us a little bit of focus. It helps us focus on this. So I want to point out, first of all, a common thread. Okay. So first we start off here with the attractiveness of the market opportunity. So many people read this and they want to talk about how big your market size is, right? Like, well, what is my addressable market, et cetera. But what is the most important thing here? It's like, can you be a significant player in the market, right? So already right at the bat, we're talking about, can you have an impact in your market? Then the value created by your product or service. It's what's your unique value, what customer need is being satisfied, how important is your product or service? And then when we get down to competitive advantage, we talk about how will this be compared to your competitors, and can you achieve a leadership position? All that is going around and around and saying, like, what is the problem and what is your solution, and why is your solution going to meet the problems or meet the needs of your customers, right? So I would argue to say that 50% of your score is your value prop. Do you guys know what a value proposition is? Okay. There's different definitions. For our definition, it is what is the customer pain point you're going to solve? Okay. What is the customer pain point you're going to solve? That is 50% of your score right there. And having done this for both pitching as well as a judge, as well as a venture capitalist, I will say the easiest thing for a judge or a venture capitalist to understand is I am solving a need. That need is X. I have defined the need. It is worth this much. That is the clearest pitch, right? I think a lot of people will say like, oh, I'm creating a new need. That's fine. I'm not saying that there's one way to do it. I'm just saying the most clear-cut way to present an idea that's going to get funded or win a competition is to say you're solving a need. Okay. That is the easiest way to understand what is a need, right? So in value prop, if you ever studied the lean methodology or the business model canvas, the value prop is what is the pain point you're going to solve for your target customer? What is the pain point you're solving? Okay. How would you figure out that pain point? Anybody? Lock. Oh. Customers. Lock. What are you saying? talk to their potential customers. Okay, now I'm going to quiz you. Hands up again. Who entered the venture competition? One. Okay. Keep up. Didn't you enter the venture competition? No. No. Yeah. Okay. How many of you talked to a customer? Okay. All right. Great. Was that in your plan? In your pitch? Great. Okay. There's nothing that can replace like customer knowledge. That is the most important critical thing, or else it's just an idea, right? And who's to say that my idea is better than your idea? I don't know. But if your customer says that idea is a good idea, then that matters, right? And I'm not just saying this as like theory, right? So the team I coached 2 years ago that won was Goal, right? So they won. So theirs was a language learning app that used AI to do real-time like learning in immersive environment. So you would go, you would read something, you would summarize it. It would tell you, did you summarize it correctly? It's for advanced language learners. How did they know that worked? Because there were 4 PhD students in language studies, and they have been studying and teaching and talking to language learners for 8 years apiece. 32 years of language learning, teaching language instructors. So that was the most powerful thing that they had. Was more so when we crafted their pitch, it was more important than the solution was like, we know this is the right answer because we have 32 years of experience teaching this, talking to students, talking to teachers. And so nobody else can tell us like what is the best solution better than we know, right? So another personal experience. I have my startup outside of here. I have an AI video startup, right? Okay, so we make videos for customers, small businesses using AI. We recently pitched and won a competition to make this for politicians, okay? So my pitch to them was, we can edit your videos in a heartbeat with AI. And I went out, and what did I do? I interviewed 20 politicians. And they all said to me, edit my video. I don't have a video. Like there's nothing to edit. Like I literally have nothing. And so we had to go back and rework our problem and our solution to like, we can make a video for you in seconds. Forget about editing a video for you in seconds. Because the point was, as we started to go out and talk to customers, we realized the problem we were trying to solve was completely wrong. All right. So I just kind of bring these examples up as just like voluntold talk about their businesses, and we're gonna be kind but work on customer value props and how we're gonna find out the value prop. Okay. But last thing, don't listen to me. Sorry for those that have attended, you guys probably seen my videos before, but don't listen to me. Listen, we're just gonna do our clip here from Jeff Bezos, okay?
But I believe that if you can focus obsessively enough on customer experience, selection, ease of use, low prices, more information to make purchase decisions with, if you can give customers all that, plus great customer service, and with our toys and electronics, we have a 30-day return policy. If you can do all of that, then I think you have a good chance, and that's what we're trying to do.
You're not really a pure internet company anymore either, are you? I mean, you've got millions of square feet now of real estate. You've got a huge and growing inventory of items that you keep in stock.
We do whatever.
And you've got thousands and thousands of employees now.
Yeah, we have over 3,000 employees and over 4 million square feet of distribution center space. And those are things I'm very, very proud of. Because with that distribution center space and half a dozen distribution centers around the country, it allows us to get product close to customers so that we can ship it to customers in a very timely way, which improves customer service levels. That's what we're about. If there's one thing Amazon.com is about, it's obsessive attention to the customer experience, end to end. And that's what those distribution centers are.
But you're not a pure internet play.
It doesn't matter to me whether we're a pure internet play. What matters to me is do we provide the best customer service. Internet, schminternet, that doesn't matter.
Well, but it does matter to your investors to know whether they're investing in a company that
No, they should be investing in a company that obsesses over customer experience. In the long term, there is never any misalignment between customer interests and shareholder interests.
Well, that's the same argument that somebody at Walmart would make as well, wouldn't they?
I don't see why not. I think they should make that argument.
So
It's a correct argument.
okay, so you'll open as many square feet of space, physical space as you have to, hire as many employees as you have to.
To service customers, absolutely. And we'll do it as rapidly as we can.
That's a very
Set up, and apologies for those I've attended my previous workshops. It's might be a little repetitive, but look, circa 1999, he's talking about, if you watch any Jeff Bezos interview from then till now, all he talks about is customers. If you ask any Amazon employees, what is the number one value? Customers, right? And so this is what I'm talking about. I think so much of what we do when we go and pitch, it's like, hey, what is our cool product or our cool feature that we're launching? But at the end of the day, all that matters is what is the customer pain point that you're solving. That is the most important thing that we can do. All right. And if I'm being selfish for like all of you pitching, that is the easiest way to win, is to prove that there's a pain point that is large and monetizable and you can solve that pain point. All right. So with that said, I'm gonna maybe pause here, and the easiest way to do this and understand is like to real life examples. So I'm gonna pick on a few people. So we're gonna go to Educates. Can you help us maybe for the Zoom? Just does this not work back? I think yes, you have to stand there. Can you tell us quickly about your
Okay, hi, my name's Candide. I'm from Educates. And what Educates is basically they provide resources for Title I students in the 4th grade. And so these resource kits are STEM related and they're in alignment with the next generation and Naho Pena'a'o framework. So the pain point, I guess, would be that teachers don't have enough funding to provide these resources for their students. And so we would basically provide the kits for free to the teachers. And this is a non-profit corporation, by the way. So yeah, so the pain point is having to connect like these benchmarks and requirements set by the DOE, but not having like the resources to do that because the DOE doesn't really give out they give us $200. I'm a teacher. They give us $200 at the start of the year. And me as an enrichment teacher, I have about 150 kids a week. So you could imagine how quickly we burn through $200 every year.
So they should clearly identify not enough funding to achieve the DOE standards, right? So we're gonna get free kits.
Mhm.
All right, so first off, pain point, so you are a teacher.
Yeah.
And you obviously teach the 4th grade.
I teach 3rd, 4th, and 5th.
And what have your teachers said?
That they would use something that is free. And another thing is like, it's hard for them to come up with these lessons that are in alignment with the DOE requirements. Like it takes a lot of time. So this would also save them time. And then it'll also promote family engagement, which has been shown lower at Title I schools because the families are working like multiple jobs to provide for their kiddos. So sorry, what was your question?
No, just whatever your teachers said.
Oh, whatever the other two. Okay, so yeah, that it's hard for them to find resources that are in alignment with these standards set. And then also sometimes they have to pay out of pocket because they don't have enough money. Yeah, so they lack support basically.
All right, free kit. Achieve. Before we ask you, what do we think some of the blocks? Why would the teacher do that? She don't even know. What would be the okay? Knowledge.
The marketing, yeah.
Awareness.
So I work at Jefferson Elementary School, so I've already kind of started it at my school. It will branch out to all the Title I schools on the island from there and then throughout the state after when I have like funding and it's more established, but that's in a couple years or a year at least from now.
So we talked about distribution. So.
Yeah,
Union?
partnering maybe with the DOE. So if I'm buying it off Amazon, they're like about a $1 to $3 each, but if we're going directly to the source, it could probably be cheaper. So let's just say $1 for one kit.
Teachers union. Or not different, but I don't think it's the teacher, right? I think it's the DOE. This is my take. Because number one, it's an obvious, like, wait a minute, I need to solve this and you're gonna give it to me, like, of course I'll use it. How, like, what is the blocker, right? Like, as I said, distribution. So let's think, if you go with my assumption that the true customer is the DOE or the school district or some, like a larger entity on the value chain here, how would we go about researching?
Superintendents, then you have to get your opinion of the
Uh-huh.
superintendent.
Yes. Okay, so talk to superintendents, all right? How would you do that? Yeah, okay. Okay, we're talking about DOE then. How would we talk to them? PR. Yep, maybe. Yep. Okay. All right.
Not necessarily for like not the teacher buying it, but if you're buying it on behalf for someone else, teachers,
Say it one more time.
like the person purchasing the product, right? Like it's not the teachers as individuals, it's the DOE. Like you
Yeah.
said, it's the customer.
Yeah, yeah. But I don't know. This is my take on it, right? It's a, again. Yeah. Yeah.
Yeah.
All right.
Yeah. I was actually gonna go through city and like state grant funding to get the money to have this project be implemented.
Yep.
Not going through the DOE, but I would explore the option of
Yep.
maybe going through the DOE if they accept it or if they see that it's valuable.
Yeah.
So, but yeah, I guess I could look into charter schools.
Okay.
Yeah.
Let's come back to my first question. All right. So let's all assume whether it's the DOE, superintendents, school boards, we're kind of saying, okay, well, if we want to grow beyond your school or the few schools that we know, we need a higher level authority to help us distribute this, right? This is my take on it, right? I go back to like, how will we interview these people and how will we know their pain point?
Mm-hmm. Yeah, so they're fun hands-on activities and the teachers have to meet like certain requirements by following standards. So instead of just having them do a worksheet, they'd say like, here's your assignment. It's a hands-on kit and they can, yeah, so it's up to the teachers to kind of dictate how they want to use it, but it's just basically a resource for them. That's a great question because then like you could always expand on it. So I'll have like a write-up of what you can do with it. So it could be 1 hour lesson or it could be like a 6 hour unit.
Yeah. Okay. But the core question, right? That's a good one.
Good question.
Teachers, seems like a no-brainer. They're free. They help you meet required standards, but there's other resources out there or what would draw them to use that, right? And then if so, how will we solve this problem on distribution? We need to probably find a way to work at a higher level, at a higher entity. So here's another thing, right? So first of all, no one's answered the question though, like how would we interview, discuss with the Department of Education, school boards, et cetera? You just knock on the door. Okay, PTA, but you're still not getting to like the school board, right? It's PTA, that's good, that's
Can
helpful,
we
but
just call them?
just walk in. All right. I don't know. It's really hard. This is why school districts are hard to sell to, right? Yeah. But that's not my point. My point is not to be like, oh, your idea is really hard. Great idea. But my point is to narrow in on the customer whose pain point we're trying to solve, right? And the reason I say this, I would think about a different customer is because I think the first problem is like, how do we get awareness in education, right? And a lot of ways is from, in any organization, it's from the higher ups, right? It's usually a top-down model for a lot of organizations, right? Okay, this is my take on it. And so I don't think anybody solved it, but it's hard. But the number one thing I'm starting is like, who is the end customer and how do we get in front of them to understand their pain points, right? Okay. One more thought. Why? Well, now a question. Do you think teachers would just adopt it themselves? Do they need approvals from the school district, the school board, the school itself?
Yeah. I think that it would probably be up to the principal.
Mhm.
So I'd probably speak to the principal to see if it'd be allowed.
Yeah.
But I don't necessarily think that the DOE would have to okay it. Like,
Yeah.
I don't know if we're affiliated, with them.
Yeah.
In that way.
So the other thing is, so teachers are buying some of these materials themselves, right?
Yeah.
How do they find out about that?
How do they find out about?
Which kits to use now that they just go shop on Amazon or
So, well, they wouldn't be buying them for me. They're free resources.
sorry, currently you're saying some of them will use their own money, right?
Yeah.
So how
So-
do they find those ones that they're using their own money for?
I think well, I don't know if they're using their own kits. Sorry, I don't know what you mean.
Oh, so you're saying sometimes teachers will use their own
Oh,
funds?
They use their own funds for materials for their classroom because the
Okay.
$200 doesn't really cover.
But not necessarily for kit. For a kit or
I mean, they could make their own kit.
Gotcha.
It's what it's up to them, I guess.
how do teachers find out like what kind of materials they want to use, or is it just the same year after year, or is there
I guess
knowledge sharing?
Yeah, it depends on the teacher, but like for me, I'm pretty creative. So like, for example, this week we worked on a project about the coconut rhinoceros beetle. So I used Donors Choose, which is like a crowdfunding website, to get clay and like poster boards, and we're gonna make like wanted posters to spread awareness about the coconut rhinoceros beetles on our campus. We have a lot of coconut trees. So I guess you just think of it, and then it has to line up with standards that are, in their lesson plans and their curriculum. So
Yeah.
you have to link it together somehow.
Gotcha. Okay.
Yeah.
So I bring this example up because great, and thank you for letting us pick apart
Sure.
your example, and thank you for being brave, and hopefully it's all helpful. But a lot of it's like at the heart of it, it's like, oh, it makes sense. Teachers need to meet educational standards. Here's something free to them to help them engage their students in a more active way than lessons and reading and homework assignments. But when we get down to like, all right, how will we get this into the hands of teachers? Then that's when the true problem starts. And then first of all, it is hard to say who the true customer is, right? You could find a way to market directly to teachers. You could go through principals, you could go through the school districts or the Department of Education, right? Each one has its difficulties. And I think anybody's been able to say like, okay, how would we reach these people to talk to them about their pain points, right? So even step one, how do we reach these other customer segments to talk about their pain points? It's hard. We haven't even figured it out, right? Granted, we spent 5 minutes talking about it. I'm not saying we've spent years and years investigating like you have, right? But this is just something I'm just trying to bring up. How do we get past this entry level thinking on here's a free resource to, okay, but what is the true pain point we're trying to solve? Well, like how do teachers find out about new resources? How do they get new resources? That's the pain point we're trying to figure out. Right? Okay, thank you so much. And I appreciate everyone that's volunteering today. All right, Kia, great. Thank you, thank you. What is your guys' idea? All right, go pitch.
Okay, so basically our idea is we're trying to revolutionize the way we think about food waste. Food waste is a really stupid problem and causes a lot of environmental damage. And basically what we want to do is we have two approaches. The first layer is we want to redistribute these food at a cheaper price. So put them in surprise bags and sell it at 70% discount. And then the second idea is we're trying to turn food waste into biomass and then turn it into biofuel, supply it to biggest energy suppliers and ultimately to power plants. And that can generate cheaper electricity bills for all US residents. But this technology, Hawaii residents, but this technology also has the capability of turning your food waste straight into gas, natural gas, CH4 to your stove top. So you're not just saving money on electricity, but also on natural gas.
All right. Okay, thank you. All right. So they're taking food waste and they're reselling it or turning it into biofuel, right? So we are saving the planet multiple ways. Awesome. Who is your customer?
Everybody who eats food, but then we also have
Is it?
wait,
Hold on.
when it from technology. Let's just focus on the technology one.
Yeah.
So the technology one.
So it'd be people with gas stoves in Hawaii right now because
Gas
the
stoves.
methane produced from the bio waste would be going directly into their gas stove. And restaurants, yes. So restaurants are gas stoves as well. So-
Okay. What do you for restaurants with gas stoves? How do they currently or what's their pain point in acquiring natural gas for their stoves?
So they currently all pay for Hawaii gas as natural gas.
Uh-huh.
I can't add on top of that. So the pain point is Hawaii residents pay 298% above average for natural gas. One. Second, by law stated, like for restaurants passing a certain size, by recycling law from Hawaii, you have to either donate or recycle all excessive food.
Okay.
So then for Hawaii restaurant, what they're currently doing based on what we talk to our customers is they're spending tens of hundred thousands of dollars buying these compost machines that takes up a lot of space in their kitchen. And nobody's taking their food waste like compost because it takes a lot of space and takes a lot of time for it to actually show result for farmers. So they ended up having to pay farmers extra bucks to take the compost that they already invested a lot of money in.
All right, so perfect. So it's a market, right? There's two sides to it. The suppliers here, and we clearly figured it out on the supply side, the pain point. There's a law, you have to recycle. What do we do with the recycling? It's costing a lot. Okay. And then on the buyer side, on the demand side, how do we know the pain point of that restaurant with the natural gas stove?
So the supplier side, we're actually supplying these biomass, ultimately to energy suppliers. So we're going to be partnering with like Hawaii Pacific Biodiesel, Par Hawaii, or oil refinery companies. So why they need this is because Hawaii is trying to reach 100% renewable energy by 2045. And currently the operation of renewable energy is only 23%. And biofuel is less than 5%. So if they do want to achieve renewable energy, this initiative imposed by the government, then they need to put more investment on clean energy. So this biomass, currently all the food waste being thrown into trash can is going straight to H Power. What does that mean? They're burning it. They're burning it with all rest of the garbage. And that takes up a lot of energy and it's not efficient. It's not generating enough fuel. So by us doing this, turning it into biomass and supplying it straight to these energy suppliers, they can make more efficient utilization of this by turning it into biofuel.
Okay, awesome. So on the demand side, the buyer is going to be what, HECO?
Okay. So let's say, for example, Hawaii Pacific Biodiesel.
How
Right.
is about?
Yes.
Okay.
Yeah. So where do they get most of their biomass? It's sunflower seeds and, soybeans, and it's being imported, right? So yeah, I mean, first off, there's about, let's just say 10 power plants on the island, right? And they're all burning gasoline to generate electricity. For it to be renewable, they have to buy imported biofuel. So as you can tell, okay, you're already paying 260% more for electricity because we're paying for imported gasoline.
No.
So now you're going to get imported biomass, which is going to be even much more expensive than gasoline.
Yeah.
Yeah. So we're cutting down that import cost because we're using the biomass already in Hawaii.
Yep. Okay.
Yeah.
So Hawaii
And
Pacific
you also
biodiesel.
skip a import tax. So right now, every barrel of gasoline has about, I think, 57 cents taxed on it. And on monthly basis, just for gasoline only, that is $48 million of tax. So, hey, if we had that supply and it's being not imported, that's already directly saving $48 million. That's to par Hawaii.
Okay.
Yeah.
So what do we think, or what do you guys know is cost their only pain point?
Cost is one of the main pain points, and then also the fact of availability, right? So it's really hard to produce biomass because the way it's currently doing, you go to South America, you chop down a whole rainforest, and then you grow sunflowers, soybeans, and everything like that, and then you kind of crunch it up a little bit, and then you bring it here to Hawaii, then you refine it.
Yeah.
So there's 3 things that happen first before it actually becomes fuel.
Yeah. But then for Hawaii Pacific biodiesel,
Mhm.
but they don't really care about the upstream supply chain, right? They're just like,
So they want to.
yeah.
They also don't have the land. There's not enough land in Hawaii. So if we wanted to go all to biodiesel, right, we either need to start building vertical towers of farms,
Mhm.
or you're going to have to go outside
Okay.
of Hawaii.
So there's
Yeah.
not enough supply
Mhm.
and the cost. All right.
Yes, that's the availability. Yeah.
Availability and
Mhm.
costs.
Yes.
Okay. And do we know that for a fact?
Yes, we do know that for a fact.
Okay. How?
How? Okay, so I'll tell you this, right? If you had an acre of sunflower seeds, how much gasoline do you think you're actually going to get out of that?
Oh, no. Hold on. Before we get that, I
Yeah.
agree. I understand.
Mhm.
But how do we know that those are their 2 main pain points?
So I actually talked to one of the managers at Par Hawaii,
Okay.
and she basically affirmed that they're importing.
No. Okay. So how do we know that those are their 2 biggest pain points? That's cost and availability. They're importing, but
It's on their website.
they said this is my pain point.
No, they didn't say this is my pain point, but then they basically stated, like, in order for them to achieve their capacity
They need
they have to rely on imported
Okay.
thing, and then it's more costly. So
So my dad actually works for PAR.
Thank
He
you.
is the
Okay,
environmental
there you
manager.
go.
And
Okay.
no, wait, sorry, he
That's-
testified yesterday, and basically PAR was going to get, they were trying to get $100 million tax credit if they could produce biodiesel here.
Yeah.
Of course, they don't even have the land to do that.
Yeah.
Right. But that was an incentive. So there is a big incentive to start producing here.
Okay.
Mhm.
So again, you
don't
can
have the
fast
land.
forward it by, yes, this is kind of my first example on the team that won last time, right? Or last year, or 2 years ago. Sometimes customer discovery is understanding their pain points, but you can't fast forward that if you know the expert customer, right? So that's the point I was getting at. I kind of knew because I talked to these guys last week. And that's my main point. It's like you need to deeply understand the customer pain point. And sometimes you can fast forward that by knowing a little bit behind the scenes, right? Okay. So what, as we think about this, how do you, okay, actually, I want to go back. Let's go back to your other half of your idea. So you also want to resell it, right? Food, sorry.
Yeah. So that's her part of the idea.
yes.
Okay. So part of it's, we're going to use some of it for biofuel and some of it for reselling. And then who is the customer there, the customer segment?
People who care about the environment and wants more affordable food.
People that want more affordable food. Okay. And what channel do you think we're going to sell this to?
What channel?
Yeah.
Like, it's going to be platform, so people pick it up.
People pick it up.
Yeah.
Okay.
So it's directly from the restaurants to the customer.
Oh, it's from the restaurant.
Yeah.
Okay. So you're pain point.
So we're just establishing a platform that will connect the existing demand and the excessive supply.
Okay. All right. How do we know that customers will want to go to the restaurant to pick up their groceries?
Let me ask you this question. Would you rather, okay, so let's say there's a Walmart that's like 10 minutes further than Whole Food, but then you know that you would save $50 if you go to this Walmart. Would you go to this Walmart or would you go to Whole Food if you get the same result? Like you can get the thing you want from Walmart or Whole Food,
Well,
but then you would
I'm a
save.
customer segment of one. So this is actually my question, everybody. Like, how do we do this research? It's less about like what do I want or what do you want? It's a general question of how do we understand this problem and how would we research our customers' willingness to.
Okay, I think I know what you're looking for. So more straightforward answer is this business model exists and they have worked. So this is based on a European model called Too Good to Go. And they have been showing that customers are willing to do this for a cheaper price to go pick it up.
Okay, that's relevant. Yeah. So we can look for similar business models, right? But I think my basic question is, it's not poking holes. It's how do we do customer discovery? If we're saying, hey, customers will go to a restaurant to buy leftover food at a cheaper price, like how would we do customer discovery?
I mean, you ask.
Yeah. Surveys. You could surveys. You could talk to customers. Like you could just sit outside of Whole Foods and Walmart and just survey people, right? That's actually my point. It's not like how do you Kia know? It's how do we do discovery, right?
Yeah.
Right. I'm just trying to get us in the mode of like talking to customers, right? And I think this is a good example because on one half of it, it's like, all right, we know because we have a known expert that's part of our buyer that says this is the way that they would buy. Okay, yes. On the other half, if we're talking about customers, I think my main point here is there's a difference in a pitch that says like customers will do this because it makes sense versus we talked to 50 customers and they said, yes, I would do this, right? And like that's my main point. I think this is what's separating a lot of the great plans from the good plans is did you talk to customers and did you validate your idea? And that's my main push. It's like, did you validate your idea? In this case, it's quite doable because we know who the customers are. They're shoppers and we can go find them, right? So again, I push here not to poke holes in everybody's plan, but just to say like, hey, how would we take this to the next level, right? Let's go talk to customers, right? Because I can talk about what Jeff Bezos says and everything, but it's more real life if we talk about a specific idea here. Okay. All right. Thanks, guys. Thank you. Thank you. Yep. All right. So last topic. Last topic that we wanted to cover. And there was a specific question from the PACE crew about, do we understand channels? What is a channel? I'm going to jump around a little bit here because there's a bunch of them. Yeah? Yeah? Okay. All right. Anybody else? Channels. I think there's a little bit of one easy way to think about it. The way I like to think about it is, let me turn that off. Okay. The way I like to think about it is, where will the transaction occur? And how will you reach your customer to get them to know about your customer? To get them to know about your product. Okay. So we're talking about Shopify, brick and mortar. That's where the transaction will occur. Okay. So I want to do this one way. All right. We think about a traditional product, right? Like a CPG product, a consumer product. So a lot of people in the venture competitions, you're going to make, let's just say, I don't know, a candle, right? There's two things. One is, where is the transaction occurring? I'm going to sell online. Great. That is one half of the problem. The other half of the problem is, how will you get your customer to know about that product, right? How will you get them to be aware of your product so that they can buy it? So the way I like to think about this is, you can broadly group it into different types of businesses. So we can talk about a consumer product. We could talk about a digital product. We talk about services. There's a lot of service businesses in our venture competition. I'm not saying that everything falls neatly in these, but these are 3 categories, right? So traditionally for consumer products, this will happen at a retail store or in an online store. You're making t-shirts, you're making clothing, you're making goods. You traditionally will sell it in a retail environment, like a brick and mortar store, or online on a sales platform, right? In an online store. How do you get your customer to know about it? Just like textbook, what are the ways? Yeah. Yeah. Okay. So you're saying like social media to push them to your Shopify store. Okay. The number 1 way, ads, Facebook ads, Google ads. Word of mouth is always nice if you can get it. Okay. So I'm gonna pick on Kia again. Kia. So you want people to, in branch number 1 here, you want to get people to buy your product. It's leftover food that we're going to repackage and sell to people that want to save money. So they're going to go to the restaurant itself to buy this product. How will we get them to be aware of your service, your product? Okay. Social media marketing. Okay, that's fine. Right. So, but this is one thing I just want to be clear, because often when we say channel, people will pick one and be like social media. Okay, but then you're going to push them. It's where are you going to get awareness and where are you pushing them to make that transaction, right? Or a lot of people say, I'll have an online store. Okay, how will you get them to be aware of that, right? All right, then there's digital products. Traditionally, this is a website. So it could be you're building an app, you're building an AI product, etc. And this traditionally will be how, if you're building an app, what are the most common ways to get awareness about your app? GitHub, right? All right, that's a good one. So you could just talk about platforms. Could be Reddit, GitHub, etc. Anything else? Say it again. Ads. Media and PR. Yep. Yep. Media and PR. Right. Okay. A service. I think the team that won last year was Crystal, correct me wrong. They were the team that won the venture competition last year was like an agency, right? Right. And so an agency, there's a lot of business plans out there for social media agencies, marketing agencies. You're traditionally, most of these companies, you don't even need a platform. You're just going to be talking to your customer. So this could be one-to-one or a website. If you're selling a service, you're usually going to talk to your customer one-to-one, or you're going to push them to your website to sign up. How would you reach them? Cold emails, cold calling, networking, LinkedIn, conferences, networking, right? All right. I just bring this up because the common mistake here is people will, when they say what channels, they'll either say, I'll have a website or I'll do social media, but it's really like, how will you get your customer to know about your product? Where are you pushing them to transact? Okay. So that's step one. The second step, I think, that truly makes great business plans from okay business plans and pitches, specificity. Everybody says, I'm going to have a social media campaign. Everybody says, I'm going to run ads. Why will your ad be worthy of my attention? your attention, consumers' attention, right? Why will your social media campaign stand out? There's a million people out there doing social media campaigns, right? So my push number one is when you get to the part about channels, to be specific on how are you reaching versus how you're transacting. My second push is to be specific. What's the best way to be specific? Show me an example. Show me your social media campaign is great. Here's what we're going to do. Here's why it's going to stand out. Digital ads, you know how cheap it is to run a Facebook campaign right now? You can go get data. Give me 20 bucks. We'll test your idea right now. And I mean that like, and I've probably failed like 10 times more than I've succeeded on any ad. But you put 20 bucks in, you can test your idea right there. So I think specificity in terms of, don't just tell me like, I'm going to do a digital ad or social media campaign. Show me what you're going to do. Show me that you've tried. Give me an example. Bring it to life. That's what's really separates a lot of the business plans from something that's just theoretical to like something that I can feel and touch and I can believe in, right? So that's my last point. A lot of what I'm talking today is what separates like the okay or the good ones from the great plans. It's like, help me believe, right? Help me believe in your idea. Number one, the easiest way is because I can show you that it solved the pain point. The customer said so, and I'm solving this pain point that they told me about. And I have proof because I've talked to 50 customers, right? Number two, show me it works. When you talk about channels, don't just say, I'm going to do media. Like, here's my press release. I did it. Someone wrote up about it already. Like, I've already sent this out and I already got media to write me up. I've ran an ad and I got success. Here's my social media campaign. I've already mocked it all out. Come take a look, right? This is what I think truly separates the plans that are like, okay, versus the plans that are great, is like, show me, prove to me that it works, right? So that's my main point today. Show me, prove to me that it works. All right. So, all right, with that, I know we kind of jumped around with a bunch of topics, but I wanted to point out these topics because if I go back to the scoring criteria, these are the most important topics because we go back to, can we go back to the business plan? Oh, sorry, this tab up here on the top left. Yep. So I go back to the scoring criteria. 50% of your score is going to be about your value prop, what makes you, what separates you. The core is like, how do I know this idea is going to work? And I'm trying to explain to you, we're jumping ahead a little bit. We're trying to explain to you what separates the good ideas from the great ideas. Prove to me it works. Okay. Don't just tell me, but prove to me. Show me customer feedback. Show me an example. Give me something that I can touch, see, feel. Okay. And that's going to be 50% of your score right there. I promise you, like, that's what really separates the good plans from the great plans is specificity, examples, real life feedback. Okay. So, I just wanted to hone on that one point to finish off. And for those not entering the venture competition, sorry if that was probably very, very specific to the competition. The last thing I'll say is, as we saw here with Educates, and then actually, Kurt and Kid, what is your company name? Aggie Power. Okay, so Aggie Power and Educates, we broke apart their ideas. Thank you guys for volunteering-ish. But really, the important thing is we can't really do this theoretically. It really has to be person by person. So I do have office hours. If you guys want to talk about your specific idea, talk about your value prop, talk about how you're positioning your value prop in your pitch, okay? Because I do want to be clear, like, I think pitches are the most formulaic thing ever. Like, there's a formula to winning pitches. So that's what I want to talk about. Come talk to me during my office hours, and I'll send those around afterwards. But it's on the Entrepreneur in Residence page on Pace. And then Addie or I will send that around afterwards to everybody. But sign up for an office hour slot, or tell me if those slots don't work and you want to meet at a different time. Because there's nothing better than just talking about your specific idea versus theoretically just looking at this list of criteria here. So with that said, anything else, Crystal or Addie, you want to close it? Yep. Yeah. So if you go to what we offer on Pace and Entrepreneur Residence,
up for.
Yeah. Totally. So just if you go here and you click on schedule an appointment, it'll just lead you to my schedule page and you guys can grab an appointment or email me if those appointments don't work. I'm happy to find another time. Nothing beats like one-on-one conversation to talk about your specific idea. Okay. All right. Thanks, guys. And good luck on the competition.